Have you ever stopped to think about what makes certain ideas, certain ways of thinking, really last? Especially when everything around us seems to change so fast?
Yeah, it's a great question. Why do some philosophies adapt and just keep going strong, while others, well, they just fade away?
Exactly. And that brings us to today's deep dive. We're looking into the mind of, arguably, the most successful investor ever, Warren Buffett, the Oracle of Omaha.
Mm-hmm.
We're going to unpack the sources you've provided. We've got the classic Buffettology books, his own shareholder letters spanning decades. We want to explore how his investment philosophy grew, how it evolved,
Right from the very beginning, right up to how he applies it today, sometimes in surprising ways.
and our goal here, our mission, is to pull out the key insights from all this material.
Yeah, it's not just what he does, but trying to understand the why. Why does his approach matter? And crucially, how has his thinking changed over, what, 50, 60 years to stay so relevant?
It's definitely more than just crunching numbers, isn't it?
Oh, absolutely. It's a whole framework for thinking clearly, rationally,
Mm-hmm.
especially when the market is, well, often anything but rational.
So for this deep dive, we're mainly drawing on those Buffettology books, the original, the new Buffettology, but also, maybe even more importantly, Buffett's own words from those shareholder letters, decades of them.
Unfiltered Buffett.
Yeah.
You can really see the thinking evolve there.
Okay, let's unpack this. Where do we start?
You absolutely have to start with Benjamin Graham.
His mentor at Columbia, right, the intellectual foundation.
Totally. Graham laid the bedrock. And what's fascinating is how those core Graham ideas stuck with Buffett, even as his own approach changed quite dramatically later on.
So what were those core ideas?
Well, the biggest one, the most fundamental, was Graham teaching him to view buying a stock not as, trading a blip on a screen,
Just a ticker symbol.
exactly, but as acquiring a piece of an actual real business, fractional ownership,
Okay, so that shifts your whole perspective.
completely. Suddenly, you're focused on the long-term health and performance of the company itself, not just the daily stock price wiggles.
Yeah.
You start thinking like a business owner.
A patient owner, presumable.
That's the idea.
Yeah.
And tied to that is intrinsic value.
What the business is really worth.
Right. Buffett thinks of it as the discounted value of all the cash that business can pump out over its entire life. It's supposed to be an objective measure,
Wow.
separate from the stock market's whims.
Okay. Own businesses, understand their real value. What else from Graham?
The margin of safety, this is huge. Buffett calls it the cornerstone of investment success.
So don't overpay, buy it for less than it's worth.
Significantly less. That's the key. It's Graham's big idea. Think of that bridge analogy Buffett uses.
Right, yeah, the bridge for 30,000 pounds.
But you only drive 10,000-pound trucks across it. That gap, that's your margin of safety.
It protects you if you're wrong or if something bad happens.
Exactly. Errors in judgment, bad luck, unexpected events. That buffer protects your downside. It's rule number one in practice. Never lose money.
That makes sense. But sticking to that, having that discipline when the market's going crazy, how do you do that? Doesn't Graham's Mr. Market idea come in here?
Absolutely crucial. Mr. Market is Graham's brilliant way to think about market volatility.
Okay, explain Mr. Market.
Imagine you have a business partner, Mr. Market, and he's manic depressive.
Uh-oh.
Every single day, he comes to you and offers to either buy your share of the business or sell you his share. The prices, he quotes, they're all over the place, totally dependent on his mood that day.
So some days he's wildly optimistic, high prices.
Exactly. Ecstatic, offers you a fortune. Other days, he's completely despondent, thinks the world is ending.
And offers to sell really cheap.
Dirt cheap. Now, the intelligent investor, according to Graham and Buffett, doesn't get sucked into Mr. Market's emotional roller coaster.
You don't have to trade with him.
You're totally free to ignore him. Or, even better, if he's having a really bad day and offering you a ridiculously low price for a good business.
You take advantage of his panic?
Precisely. The market is there to serve you with opportunities, not to instruct you or tell you what your business is worth. You use your own calculation of intrinsic value and your margin of safety.
So you ignore the noise, control your own emotions, and use the market's irrationality. It sounds simple, but I bet it's incredibly hard in practice.
It requires real emotional discipline. That's a huge part of Buffett's success.
Okay, so that's the Graham Foundation. But Buffett didn't just stay there, did he? This is where it gets really interesting, the evolution.
This is the game changer, largely thanks to Charlie Munger, his longtime partner, and also picking up ideas from Philip Fisher.
Munger's influence seems huge. What was the core shift?
Buffett started out very much in Graham's camp, looking for those cigar butts.
Cigar butts.
Yeah, finding a mediocre company, trading for way less than it's worth, maybe less than its liquidation value.
Yeah.
You pick it up cheap, get one last puff of profit out of it, and then move on.
Okay, buy cheap, even if the quality isn't great.
It worked for him early on when he was managing smaller amounts of money, but he realized it wasn't scalable, and it wasn't really building long-term compounding wealth. Owning mediocre businesses is just hard work, constant problems.
Makes sense. So Munger pushed him towards.
Munger famously convinced him, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Ah, the quality argument.
Exactly. Because, as Munger also said, time is the friend of the wonderful business, the enemy of the mediocre.
That's a powerful idea. Time helps great companies compound, but just exposes the flaws in weak ones.
Precisely. So the focus shifted dramatically from just cheap to quality and durability.
So how did they start identifying these wonderful businesses? What were they looking for?
This led straight to the concept of economic moats.
Like a castle moat, protecting the business.
That's the analogy. A durable competitive advantage that protects the company's profits from competitors over the long haul.
What creates a moat?
It could be several things. Powerful brands like Coca-Cola or Apple, people trust them, pay a premium.
Okay, brand loyalty.
Or being the lowest cost producer in an industry. High switching costs. Think about how hard it is to change banks sometimes, or enterprise software.
Yeah, the hassle factor keeps you locked in.
Right. Or network effects where a service gets more valuable the more people use it, like a dominant social media platform or credit card network. Buffett wants businesses with wide, sustainable moats. Ideally, moats that are getting wider.
And this changed how he thought about value itself, didn't it?
Fundamentally, value wasn't just about tangible assets anymore. Factories, inventory, stuff you could easily count on a balance sheet.
Which was more the Graham approach.
More of the Graham approach, yes.
Mm-hmm.
The new focus was on the long-term predictable earning power of these superior businesses. It brought in qualitative factors, the strength of the brand, the quality of management, future growth prospects, without needing tons of new capital. That's where Philip Fisher's ideas about growth and management quality really resonated too.
So it became a much more forward-looking assessment of quality and durability, not just a snapshot of current assets. Okay, that makes sense. Time helps the good ones. So with this evolved mindset, how does Buffett actually put it into practice? You mentioned a filter, a checklist.
Yeah, he operates with this really disciplined 4-part filter. It's designed to weed out almost everything and leave only the highest conviction ideas.
Let's break it down. Pillar number 1.
Pillar 1, the business itself. And crucially, staying within your circle of competence.
Meaning only invest in what you truly understand.
Exactly. Buffett is adamant about this. He has that famous quote, something like, what counts isn't how much you know, but how realistically you define what you don't know.
So humility is key.
Huge. He avoids businesses that are too complex or undergoing rapid, unpredictable change. No turnarounds, usually. If he can't clearly understand how the company makes money and what its sustainable advantage is, he just passes, full stop.
Simple and understandable. Okay, pillar 2.
Pillar 2, management. You need talented, rational, and importantly, candid managers running the show.
Rational and candid. What's the key test for them?
A huge one is their capital allocation skill.
Mm.
What do they do with the profits the business generates, the retained earnings?
Do they reinvest it wisely?
Right. Do they put it back into the business in high-return projects that strengthen the moat? Do they make smart acquisitions that actually add value? Or, if internal opportunities are scarce and the stock is cheap?
Do they buy back shares, give it back to the owners?
Exactly. Buying back shares intelligently is a big plus for Buffett. What you don't want to see is management squandering capital on ego-driven deals or low-return pet projects. That's a major red flag, even if the core business is good.
Okay, so assess the business, assess the managers running it. Pillar 3 must be the numbers.
Pillar 3, the financials. Yes, you need the hard data to back up the qualitative story. Buffett digs into several key things here. He looks for a history of consistently high return on equity, ROE, often over 5 or 10 years. For him, ROE is like the ultimate management report card. How effectively are they using shareholder money to make more money?
Makes sense. What else? Debt.
Big one. He prefers businesses with little or no debt. Companies that can fund their growth from their own earnings are generally stronger, more resilient, less risk.
And profit margin.
Wants to see strong, stable profit margins. High margins often signal efficiency, but more importantly, real pricing power, the ability to raise prices without losing customers. That often points to a strong moat.
You mentioned something called owner earnings before.
Yeah, that's a Buffett refinement.
Yeah.
It's basically trying to figure out the real cash flow the business generates for its owners after accounting for all the necessary capital expenditures to maintain the business and its competitive position. It's often a more realistic measure than standard accounting net income.
Got it. So understand the business, trust the management, check the financials for strength and profitability. What's the last hurdle?
Color 4, price. This brings us right back to Graham and that margin of safety.
Even the best business isn't a buy if the price is too high.
Absolutely. You can have a wonderful company, great managers, fantastic financials, but if you pay too much, your returns will likely be mediocre or worse. Buffett is legendary for his patience here.
Willing to wait for the right pitch.
Exactly. He'll happily sit on huge piles of cash for years if he doesn't see compelling value. He knows that sometimes the best investment is doing nothing. The Buffettology books talk about calculating an expected annual compounding rate of return. He apparently used to use a simple Texas Instruments calculator for this, looking for a hurdle rate of maybe 15% or more.
So that price discipline is the final critical filter.
Wow.
It really is a rigorous process designed to say no most of the time.
That's the point. Eliminate the vast majority of possibilities to focus only on the truly outstanding opportunities where all 4 pillars align.
Okay, so that's the framework. But the big question, especially now, does this philosophy, forged decades ago, still work? Is it relevant in the 21st century with tech dominating intangible assets? Some people say value investing is dead.
Yeah, that's the elephant in the room, isn't it? And it's a challenge Buffett himself has clearly grappled with and adapted to.
How so?
Well, for a good chunk of the last decade or so, traditional value metrics like low price-to-book value, which Graham favored, have seriously underperformed. Why? Largely because of the rise of the intangible economy.
Companies built on software, brands, R&D, networks.
Exactly. Assets that don't always show up neatly on a balance sheet because accounting rules often require things like R&D or brand building to be expensed immediately, not capitalized as long-term assets.
So the old metrics don't capture their true value, leading people to say
that value investing is dead.
Yeah.
Or at least that the old ways of measuring value are broken for large parts of the modern economy.
So how does Buffett square that? I mean, his massive bet on Apple seems to fly in the face of his old avoid tech stance.
Apple is the perfect example of his adaptation. Berkshire started buying Apple in 2016. But Buffett wasn't suddenly trying to predict the next hot gadget.
So how did he view it?
He saw Apple not primarily as a tech company, but as a phenomenal consumer products company with an absolutely enormous economic moat.
The ecosystem, the brand.
All of it. The iPhone as the hub, the incredible brand loyalty, the customer satisfaction, the high switching costs of leaving that ecosystem. He saw immense economic goodwill, that intangible value driving predictable, massive cash flows.
And the price was right at the time.
Critically, yes. When Berkshire started buying, Apple was actually kind of out of favor, trading at a PE ratio in the low teens, maybe 10 to 15. Very reasonable for that quality. Plus, Tim Cook's management was doing exactly what Buffett loves with capital allocation.
Buying back shares like crazy.
Aggressively. Systematically increasing Berkshire's ownership percentage without Buffett having to lift a finger or spend another dime.
Okay, so the Apple purchase fits the evolved philosophy. What about the recent trimming of the Apple stake? Does that fit too?
I think it does. Perfectly. Some people saw it as him losing face, but look at the valuation. Apple's PE ratio had climbed significantly, maybe towards 30.
So the margin of safety shrunk.
Exactly. The price became less compelling relative to the intrinsic value. So trimming the position, taking some profits, rebalancing the portfolio because it had become such a huge part of it, that's just prudent risk management.
Like managing position size.
Right. And maybe learning from past experiences, like holding Coke when its valuation got really stretched and returns then stagnated. Plus, there are always tax considerations when realizing such large gains. It's consistent discipline, not a change of heart about the business itself.
So the verdict on value investing is dead.
It seems pretty clear, both from Buffett's actions and the broader consensus, that it's not dead, it just evolves. Value investing has always gone through cycles. Periods of underperformance are normal.
And sometimes those periods are followed by strong comebacks.
Historically, yes. Often when the valuation gap between expensive growth stocks and cheaper value stocks gets really wide, like it has been recently, that sets the stage for value to outperform significantly. It's more cyclical than existential.
Okay. And this ties into Berkshire's own situation, right? That massive cash pile everyone talks about.
Over $167 billion now, I think. It's staggering. And it highlights the challenge of scale.
Not enough big companies cheap enough to buy.
Pretty much.
Yeah.
The universe of businesses large enough to actually move the needle for Berkshire Hathaway is already small. Finding one of those elephants, as Buffett called them, that also meets his strict quality and price criteria in today's market. It's incredibly difficult.
So the cash pile isn't market timing, it's just a lack of opportunity meeting his standards.
Largely, yes. It's a symptom of his unwavering discipline in a market he often finds overvalued. But that cash also gives Berkshire incredible firepower.
To act when others can't, like in a crisis.
Exactly. It positions them to be a source of stability and capital when markets panic, like they were in 2008, providing huge sums when liquidity dries up for everyone else.
Okay, so if we sort of summarize this evolution, Graham versus modern Buffett, what's the core difference in a nutshell?
Well, the sources highlight this clearly. Traditional Graham value, influenced by Graham, mantra is buy fair companies at a wonderful price, the cigar butts. Analysis, mostly quantitative, balance sheet focused, ignored intangibles, viewed tech skeptically.
And modern Buffettology.
Influenced heavily by Munger and Fisher. Mantra, buy wonderful companies at a fair price. Analysis, starts qualitative moat, management, brand, then quantitative. Intangibles like economic goodwill are key. Tech is okay if you understand it as a consumer business with a load, like Apple.
That's a great summary of the shift. So after this whole deep dive, what's the main takeaway for us, for the listener trying to navigate investing today?
I think the most crucial lesson from Buffett's whole career is recognizing the difference between timeless principles and transitory tactics.
Okay, explain that.
The timeless principles are things like emotional discipline, controlling fear and greed, having that contrarian streak, thinking long-term, remembering time is the friend of the wonderful business, adopting a business owner mindset, and intellectual humility, knowing your circle of competence. These things are always true, always valuable.
Those don't change with the market.
Never. But the transitory tactics, the specific methods you use to analyze companies, the valuation metrics you prioritize, those must adapt.
Especially with intangibles and tech changing the game.
Exactly. You can't just rigidly apply 1950s price-to-book analysis to today's economy. You need to evolve your toolkit to understand and value things like brand strength, network effects, recurring revenue models. It's about being flexible in how you apply those timeless principles.
That makes a lot of sense. And for the average person who maybe doesn't have the time or, frankly, the skill to do that deep analysis, what's Buffett's advice?
His advice is remarkably consistent and pragmatic. For most people, the best path is simply to consistently invest in a low-cost, broadly diversified index fund, like an S&P 500 tracker.
Just own the whole market, basically.
Pretty much. He argues, convincingly I think, that for the vast majority, trying to actively pick stocks or time the market leads to worse results than just passively participating in the long-term growth of the economy via an index fund. It sidesteps the need to outsmart Mr. Market or become an expert analyst.
So keep it simple, control your costs, stay disciplined.
That's the core for most investors. Ultimately, Buffett's story isn't just about getting rich. It's a masterclass in adaptation. Grounding yourself in rationality and patience, but having the intellectual flexibility to change your methods when the world changes.
So for you listening, the 21st century investor, perhaps the challenge and the real opportunity is exactly that. How will you take these timeless principles and adapt your understanding of value for today's and tomorrow's economy?